we're talking about rates, we're talking about jobs. I actually want to pick up on the latter first, because you have a forecast for the unemployment rate that is considerably higher than where the Fed is projecting it will go.
The world of economics is a labyrinth of interconnected factors, and one such crucial element is the impact of interest rates on the job market and inflation. As we navigate through this complex subject, it's essential to break down these concepts into simpler terms for a broader understanding. For more than 2 decades, the United States has been entrenched in an environment characterized by historically low interest rates. This extended period of ultra-low rates was instrumental in shaping various facets of the economy, influencing borrowing costs, investments, and consumer spending. However, the tides are now turning. Currently, the country is witnessing a notable shift as interest rates soar to levels not experienced in over 2 decades. This transition marks a significant departure from the era of prolonged low rates that defined the economic landscape. The anticipation of rate cuts in 2024 is met with the firm assertion by Vanguard economists that the era of rock-bottom interest rates is gradually coming to an end. This prognosis suggests that the economy is on the brink of a substantial transformation as the prevailing environment of exceptionally low borrowing costs gives way to a new reality. This impending shift holds immense significance, heralding changes in various economic sectors and influencing market behaviors across the board. As the economic climate adjusts to this new trajectory, businesses and consumers alike are compelled to reassess their financial strategies and decision-making processes. Investments, loans, and spending patterns that were adapted to an era of historically low rates may undergo reevaluation. Industries reliant on favorable borrowing conditions may experience shifts in profitability and operational strategies. Additionally, consumers accustomed to accessible credit and low mortgage rates may need to navigate altered financial landscapes. The potential departure from ultra-low interest rates prompts discussions and analyses within financial circles, as experts and policymakers weigh the possible implications and chart the course forward. This transition period invites scrutiny and anticipation, with stakeholders eagerly observing how the economy responds to these changing interest rate dynamics. The conclusion of this era of rock-bottom rates signifies an inflection point, requiring adaptability and agility in navigating the evolving economic terrain. As the anticipation of rate cuts looms on the horizon, the impact on investment strategies, consumer behavior, and economic growth remains a focal point for economists, businesses, and individuals alike. The impending changes in interest rates mark a crucial juncture in the economic trajectory, shaping the path ahead and prompting proactive measures to navigate this evolving landscape. The employment landscape stands as a critical pillar in assessing the ramifications of ascending interest rates on the economy. Analysts and economists have put forth forecasts that suggest a possible deviation in the anticipated unemployment rate compared to the projections made by the Federal Reserve. This unexpected divergence in forecasts is underpinned by multifaceted factors that warrant a closer examination. A potential decline in inflation during this period could signify an organic correction due to an economic slowdown, diverging from immediate impacts of policy interventions. This potential shift prompts a reevaluation of the soft landing hypothesis, underlining the need for adaptable strategies amidst evolving economic dynamics. The Federal Reserve, often referred to as the Fed, holds a pivotal role in steering the nation's monetary policy. Their actions concerning interest rates are closely scrutinized as they navigate through economic fluctuations and aim to maintain stability. The Fed constantly monitors various economic indicators, among which the unemployment rate stands as a significant metric. Should this indicator surpass the Fed's projections, it could trigger a reevaluation of monetary policies. The possibility of the unemployment rate exceeding the Fed's projected figures could prompt the Federal Reserve to consider implementing rate cuts sooner than initially anticipated. This adjustment might come into play around the midpoint of the year, as the Fed seeks to respond swiftly to changing economic dynamics. The objective behind such preemptive action would be to mitigate potential negative impacts on the job market and the broader economy. However, the Federal Reserve exercises caution and prudence in implementing significant policy changes. For them, witnessing sustained declines in inflation concurrently with a notable increase in unemployment is crucial before executing substantial adjustments to monetary policies. This approach aligns with their overarching goal of maintaining economic stability while safeguarding against inflationary pressures. The Fed's decision-making process involves a meticulous analysis of a plethora of economic indicators beyond just the unemployment rate. They consider inflation trends, GDP growth, consumer spending, and global economic factors, among others. The interplay of these diverse indicators guides the Federal Reserve's decisions, ensuring a comprehensive assessment of the economic landscape before initiating policy changes. In essence, the Federal Reserve's response to changes in economic indicators, particularly concerning interest rates and unemployment, is a strategic and meticulous process. While they remain vigilant and responsive to fluctuations in the job market, their actions are calibrated, emphasizing the importance of sustained trends in key economic metrics before enacting significant policy shifts. This cautious approach aims to strike a balance between supporting economic growth and maintaining price stability, ultimately steering the economy towards sustainable and balanced growth. Investors are navigating uncertain waters characterized by conflicting market predictions. The prevailing market sentiment suggests two potential scenarios: either unemployment rates surge, aligning with the market's anticipated Federal Reserve cuts, or unemployment remains relatively low, resulting in less aggressive rate adjustments. This ambiguity signals a phase of volatility, prompting investors to reassess their strategies. A cautionary note is sounded against overconcentration in cash, advocating instead for diversification and balance as prudent strategies, particularly for long-term investors. The lessons learned from the economic landscape of 2023 emphasize the importance of adopting a balanced, diversified approach, rather than aiming solely for short-term benchmark outperformance. In summary, the economic horizon appears shrouded in uncertainty, presenting divergent paths that lie ahead. Short-term volatility might be an immediate consequence, urging a more cautious approach. However, maintaining a balanced, diversified portfolio might prove to be a resilient strategy amidst this uncertainty. As we step into the new year, investors would do well to draw insights from the lessons gleaned in the preceding year, focusing on diversification, maintaining balance, and adopting a long-term perspective. These principles could serve as guiding lights amidst the fluctuating tides of the ever-evolving economic landscape. Like, share, and subscribe for more insightful content.